there, folks. How are you today? Welcome to the Smart Money Program. My name is Frank Corby, your host. And as I promised, every time we do an interview, every time we have a show, it gets better and better. Now, just stay in your seat and hold on for a second. I want you to take a look at this book right here. See this book right here? It says, Creating a Portfolio Like Warren Buffett. The author is called Jeeva Ramaswamy. Now, I have Jeeva with me today, and he has a wealth full of information how to help you create yourself a successful stock portfolio using some of the best strategies that's been implemented by Warren Buffett and his partners. Jeeva, how are you doing today?
Yeah, fine. How are you?
I'm doing excellent. Welcome to the Smart Money Program. Now, I'm very impressed by reviewing your book. What's getting to you to decide to write this book?
Actually, I'm basically a software engineer, but when I started interested in stock market, I was looking for who is the master where I can learn from. I started reading a lot of Warren Buffett books, his annual report, and tried to did the re-engineering of his past investments.
Absolutely.
So I started learning a lot of Warren Buffett principles, then started putting my own money. I generated very good return for many years. So then that confidence pushed me to start my own fund. Then I generated excellent return for my partners also. So to put all those experience into the book, then I decided to write this book.
Excellent. So I know you currently manage, it's called a GI investment funds. How large is your fund portfolio?
Right now, it's I started with like $25,000. It's managing around like 1.2 million right now. So last 3.5 years, my return is market beating return.
Well, from what I read here, it's not just market beating. I understand you guys are able to put together about 72% return. Is that per year or over the 3 years time frame?
Yeah, that's right.
Is it per year or over the 3 years time frame?
3.5 years time frame.
72%.
Yeah.
Wow, that's amazing. So let me ask you this. So you start off your fund in November 2008, and to date, you guys managed to generate over 72%. Now, I'm just going to be the devil advocate for a second. One might say the market declined in 2008. So if anyone had invested then, their uptrend is pretty much guaranteed. What did you do different?
No, because during the financial crisis, after the September Federal Reserve intervened in the market, a lot of people are selling their shares at bargain prices without thinking about the true value of the company. Warren Buffett used to say that when other people are fearful, be greedy, be fearful when other people are greedy. So when other people are selling their shares in 2008 and first quarter of 2009, I was keep on buying all those shares because I know the true worth of the company. So that process gave me a great return over the years.
Excellent. Now, in every portfolio, there's one strong horse that leads the race. In the stocks you were buying, what was the number one stock that was pulling everybody up in your portfolio?
If you take any position, you have to think long term. You should not worry about a particular day news that will affect the prices. You buy the stock, you hold it for many years. You have to approach stock market investing as a business owner point of view instead of holding tradable securities.
So you're saying that if I'm investing in a stock, I should actually think of myself as part owner of that company.
Yes, yeah, that's the way you have to behave. Say, for example, if you are buying a stock at, say, $20 per share, in a couple of months, if it goes to 18, you should not feel that you lost 20% of your 10% of your money because it's a quotational loss. But if the company is economic is improving, the company is going up as a business point of view, you have to hold your stock. So you should not worry about everyday price fluctuation much.
Okay. So let's say we follow your strategy. We're not, what you're pretty much saying, don't get emotionally involved in the up and down of the daily activity of the stock, right?
Yes.
So let's assume we own a stock. Let's say we own Apple, and we see Apple decline 30%. All the fundamentals look good, but the stock still decline 30%. Should we still hold, or at what point should we exit that stock?
If the company fundamental is improving, you have to hold that stock. But before you get into Apple, you have to get in at the sensible prices. For example, if you got into Apple 10 years back, it was trading around like $11 a share. If you hold it for last 12 years, now it's around 50 times of your money. So when you are getting into the stock, you have to calculate what is the company worth. Then you have to buy discount to that worth. Say for example, you are calculating Apple worth is around say $600. If you get in around like $500, then that's the good price. So that's what I explained in the book, how to research a company. There are 61 research checklist items explained with the examples in the book. And also I shown step by step how to calculate the company worth. That one they call it as intrinsic value. So you have to buy below that company worth. So then you have a margin of safety.
Excellent. So in the 6-to-1 steps that you put in the book, the 6-to-1 checklist, one might say, well, Jeeva, I don't have the kind of time to research that company to do all that work myself. What is the average person supposed to do? Should they just do all the research and buy the stocks or invest themselves, or should they deal with a manager like yourself?
People can do both the ways. Suppose if the person don't have a time to invest to research a stock, then they should not invest themselves. They should give it to professional or whoever does the full time. But if a person wants to invest some time and invest their own money, then they have to do all the research. They should not act by price action of the stock. So if a person going to do it, they have to do it thoroughly, doing a lot of research, then only they have to do it.
Excellent. And I see you mention in your book, you said investors should have strong investment principles, patience, and confidence when in their own research, and most important, they need to believe in themselves.
Yeah, that's very important because, for example, you calculate the company in worth is $10. When it goes to $7.50, you should not lose faith on your research. But the whole world is saying that company is worth only $7.50. But as per your estimation, you know that company worth is $10. So if you know company very well, you will hold that stock to come back to 10 or go over that. So you have to research a company. You should have a confidence on that company worth. Then when the market goes against you, you will have a willpower to stay in there. Then you can make money. Suppose if you don't have a willpower, you will go ahead and sell at $7.50. You will lose 25% of your money. After you sold, stock will go up to $12, $13, then you will kick yourself. So you should have a clear idea about the company worth.
Excellent. I see you mentioned in your book, and I like this one. You says the investors shouldn't buy the stock Warren Buffett is buying, but should they really understand Warren Buffett principles first?
Yeah, no, that's the thing, because he's managing $100 billion portfolio. He cannot buy small cap, mid cap companies. He cannot buy billion-dollar market cap company because he has a lot of money. He has to look for 50 billion or $100 billion company. So when you are buying a $100 billion company, making 30-40%, it's possible in 4 or 5 years. But if you are applying the same principles, what Warren Buffett using to buying small mid-cap companies, you can make 3 to 5 times of your money in 5 to 6 years. For example, I can tell you my experience. I explained it in the book also. There was a company called Select Comfort. I was following that company for 2 years. One point of time, I bought their shares, average price around 45 cents per share. I sold it around $10. I made 20 times of money within a couple of years using same Warren Buffett principles.
Excellent. All right, folks, we're here with the Smart Money Program. If you just tune in, with the author, Jeeva, who wrote the book. It's called Creating a Portfolio Like Warren Buffett. 6-to-1 checklist steps on how to create your own portfolio. All the research, guided you step by step to get the research done to start buying stocks, mutual funds, ETFs, and make yourself a financial portfolio that's going to do well to you over time. Now, Victor, I want to ask you this. Warren Buffett does many different things. And my question is, what sector that Warren Buffett mainly focus on? Or is he very diversified in the sense of sectors?
Yeah, he buy the sectors. He don't go near to the technology sector because he don't understand that business very well.
So no technology, number one.
Yes, recently he bought into IBM. That's falls under technology space or industry, but it's IT services company. So he buys like a Coca-Cola kind of companies. He can understand the business better, and also the business doesn't change for many years into the future.
Okay.
So people look for simple business, and it's growing for long term.
Right. So no technology. Is he heavily invested in like the financials and insurance companies?
No, he invests in like a railroad companies, other consumer staples, because he doesn't go to near technology because he has lack of aptitude in that field. Because his philosophy is, if you are not able to find out what is the company will look like 10 years from now, you should not invest in that company. So he don't understand the fast technology change, so he don't go near to those companies.
So you've been investing over the last 3-4 years plus with investing in the sense of other people's money with your fund. Did you touch technology or not?
Yeah, I touch some software companies because basically I'm a software engineer, so I understand that space very well. So if the Warren Buffett is not touching technology, it doesn't mean people should not buy technology company, but they should understand that business very well and also how the business will look like in the future. Then they can apply same Warren Buffett principle in technology space also.
Excellent. Good stuff, Victor. Good stuff, Jeeva. One of the toughest things I see is you mentioned in your book here, you said an investor should hold a losing stock for at least 2 years before selling.
Yeah, because that's very important. Because if you're buying a stock, it can gyrate any time. You should give a sufficient time for that stock to recover or company to recover. For example, if you are buying into some turnaround companies, turnaround doesn't happen within 2 months or 3 months. It takes time to turn around the company. So you have to be patient to come back up of your positions. So maybe if you're buying today, next week goes down, you should not get afraid and sell it. Then after you sell it, it will come back. So you should have sufficient time given on the particular investment.
Excellent. So let me give you an example. Assume I'm a brand new investor. I have about $10,000, $20,000 to invest, and I'm looking to start off. I have no clue when it comes to stocks or much of an investing. What kind of stock should I be looking at? And what are the key factors that I should be looking in the research checklist?
So the first thing is look for companies in your area. So what is your full-time job? Suppose if you are working in metal industry, look for companies in that industry. So then start going through the checklist, which I explain in the book. The first thing is, it's a simple business. Do you understand that business? That's the first thing. If you don't understand, say for example, you are a metal guy, if you are researching some semiconductor company, that's not your knowledge of experience. So don't go near that. So that's the one thing. Second, look for companies have brand names or competitive advantage. So you have to go one by one, explain in the checklist, then you will have a clear idea before investing any money into any of the stocks.
Excellent. So, so we always look for stuff in our local area that we can see, feel, and touch, and see how the business work. And you even mentioned sometimes we should visit that company, go on their site and see exactly how they operate.
Yeah, because if you have access to those companies, you go and see the company, talk to the management, try to give them, pose them a difficult question. Okay, if economy goes to recession, what happens? How you are going to handle it? How did they perform when the previous recession happened? So put all those questions. Suppose if you are putting, say, 20-30% of your money in the particular stock, you should know in and out of that company and try to understand that company. So then you will have a clear idea about the company worth.
Excellent. Have you owned any Canadian company in your big portfolio there, Jeeva?
Yeah, right now I'm holding potassium. It's a potash corporation because it's a fertilizer company. World population is growing, so I bought it at bargain price. Even now, it's trading at bargain price. If you buy it today, hold it for 3 to 5 years, at least you will double your money.
Oh, really? That's good. That's a good tip. So there you go, folks. The smart money trade. Jeeva just give it to you. Potash is a Canadian company. So get on board, load up. Should we load up or just a small percentage of our portfolio, Jeeva?
No, you can load up because of Europe debt crisis. Now Greece is creating some news, so people are selling it. So potash is trading near 52 weeks low, and also it's trading discount to the company worth. And also they have a lot of cash in the balance sheet, and also they have a growth rate. Obviously, world population is going to grow, so they will sell more fertilizer the years to come. But whoever buys today, they have to be patient. They should wait at least 5 years to see the return from this company.
Excellent. That's a very good tip. I'm definitely going to load up on some potash really soon. Now, in Canada, Canadians are very conservative with our investment. And we often put most of our money in the Canadian financial institutions and insurance company, preferably Canadian banks. What's your opinion on the Canadian banks?
Actually, Canadian banks did better job than American banks because financial crisis happened because financial banks are lending a lot of mortgages to high priced real estate. Then burst happened. Actually, Canada banks did better job than US banks, so that's why they fared better in 2008 and 2009.
So should I be buying into the Canadian banks
Yeah, I didn't have any investment in Canadian banks right now, but you have to research the company as explained in the book. Then you have to calculate the company worth. Then you have to buy below that price.
And here's a question: Is insurance companies a recessionary proof model?
Depends upon their business model. Say, for example, AIG took a lot of risk. Then the government came in and put a lot of money into that company. So you have to look for company. They have a good capital levels. They can withstand the recessionary conditions. So there are different factors when you are analyzing the insurance companies.
Excellent. Again, folks, we're here on the Smart Money Program with Jeeva, the author of Creating a Portfolio Like Warren Buffett. How can folks get access to your book, Victor?
Yeah, they can buy it from Amazon.com. And also there is a Kindle edition also is there. So they can buy it from there.
Excellent. And do you have a website they can get access to, or?
Yeah, the website is gjfunds.com.
Okay, that's gjfunds.com is Victor website. Jeeva website. You can access, you can get his book there and more information on investing in the Jeeva fund, in the GJ funds, sorry. Now, I'm talking to some folks before we do this interview, and some folks say, well, Frank, Warren Buffett make billions of dollars from buying and selling companies. Why are we buying stocks when Warren Buffett buys and sell companies?
No, because Warren Buffett have a lot of money to buy the whole company. So we don't have that kind of money to buy the whole company. But he applies the same principles when he's investing in the stock also. The reason he's buying the whole company, he can reallocate the capital. So if business is generating good cash flow, if they don't need that money, they can give it to Buffett. Then he can go and invest in another company or buy in the another company. That's the way he built his whole empire. If you invested $10,000 with Warren Buffett when he started, when he took over Berkshire Hathaway at 1967, it would be worth now around $50 million.
Right.
So
Yes.
he made 5,000 times money using the same principle.
Excellent. So if I want to become the next Warren Buffett, should I start taking investors' money, create my own fund, and start buying companies too?
First, you have to start research companies, invest your own money, get confidence, generate a good return, then show that return to other people. If they trust their money with you, then start the same way. That's what I did. I used to run IT software company, but I have a passion for stock market investing. Then I generated good returns on my personal portfolio. I started with $25,000, my own money in the fund. I shown the return after a year to a particular investor, then he gave money, then investors keep on coming in. So that's the way you have to build the business, because other people needs to trust you, and also you have to show your performance to other people, then people will start giving money. Warren Buffett started the same way. He put $100 his own money, then collected 100,000 his family and friends. Then he built it from that 100,000, built a $120 billion company.
Excellent. And I like you said confidence, and just elaborate. Why is confidence so much important in investing or business, Jeeva?
Because you should have a confidence on yourself. Because there will be a lot of roadblocks when you are doing any business. For example, take I started the fund. I was trying to get investors to put money in my fund even before starting, but I couldn't able to get anybody to convince. Then I started with my own money. Then I built the track record. Then I was talking to other accredited investors to invest the money. So if you don't have a confidence, if you lose your heart even before starting, thinking that, oh, nobody gave me money, I don't want to start it, then it won't work out. So you should have a confidence on yourself, then start the business, whatever you are doing, then work hard on it, then you can able to build big companies. That's what Warren Buffett did it to. When he started his own at the age of 25, he had a great confidence on him, saying that he can generate good return for his investors. So everybody should have a confidence to build their personal life, business life, whatever they are doing.
Excellent. Again, we're here with Jeeva, the author of Creating a Portfolio Like Warren Buffett. Jeeva is also a fund manager. He's managing the GJ Investment Fund. And one the thing that I read about you, Jeeva, is really amazing. In your fund, you charge no management fee, only a performance fee, and you only charge a performance fee after you paid out 6% to the investors. How do you manage to do that?
No, because this idea also I got it from Warren Buffett. When he started, he did the same thing. No management fee, just a performance fee after 6%. Because I feel that if my investors don't make money, I should not deserve to get paid. Say, for example, if a guy is managing $1 billion, normal fee structure in the hedge fund industry is 2% management fee and 20% of the profit. If a guy is managing $1 billion, if he is making 2%, that is a $20 million. Why he needs to work hard to generate return for his investors? So I don't believe in that. My belief is, if my investors make money, just I want to share the profit with them. If I don't make money for them, I don't deserve to get paid.
I like your model, and I wish more North American fund managers or people who manage big portfolio would duplicate the same model, because I think a lot of stocks or mutual funds these days are not making a lot of money and just keep taking more money from investors. And because of that, a lot of people are losing confidence in all this negative loss, and a lot of people have money sitting on the sideline. So you think this is a strategy more managers will be willing to take on?
Yeah, because only maybe couple of hedge funds are doing like this, but normal form is like a 2% and 20% of the profit. That's the way they built the whole industry. So if a person is going to differ, they will be exceptional in the hedge fund industry.
Excellent. And are you currently looking for investors or to partner up with or to manage your funds?
I'm looking because hedge fund allowed only accredited investors allowed invest in the fund. So that means the person net worth should be more than $1 million, not including the house. Only they are allowed to invest in the fund. So I'm looking for accredited investors, family offices, and institutional investors like a pension funds and those kind of people.
So a person has to have close to $1 million net worth, not including their personal home, to invest with you.
Yes.
Okay, and if they have $1 million of net worth, what's your starting fee for them? Like, for instance, how much you need to bring to your table to invest with you?
$100,000. That's the minimum investment in the fund, because there are a lot of expenses included and those kind of things. So it's 100,000. It's the minimum investment to invest in the fund.
So I give you $100,000. Can you duplicate 72% in the next 3 years?
No, depends upon the available market, because when I started 2008, I explained there are a lot of bargains in the market. So if I do like 25-30%, I will be happy, because Warren Buffett compounded his money last 47 years at 19.87%. So that gave 5,000 times of your initial money. So if I able to do like 25-30%, I think long term we can make a lot of money.
Excellent. Sounds good. So if investors want to contact you towards for you to start investing with them, how do we get access to your company?
They can go to like gjfunds.com. There is a contact information. They have to send it. Then we will send a form saying that find out really they are accredited investors or not. Then after they identify themselves as accredited investors, then we will send all the documents and subscription documents and everything. Then they can invest the money after that.
And do they need to be in the U.S. or anywhere in the world they can invest with your funds?
Anywhere in the world. As long as they are accredited investors, they are allowed to invest in the fund.
Excellent. Sounds good. Again, folks, we're here with the Smart Money Program and talking to Jeeva, the portfolio manager of GJ Investment Funds, also the author of Creating a Portfolio like Warren Buffett. The GJ funds have managed to give investors about 72% return on their money over the last 3 years, starting off in 2008. And Jeeva, you promise you're going to duplicate that return, or what's going to happen?
Because I don't know. Because in investing world, you cannot promise anything. So it depends upon available opportunity right now, than what you can produce in the future. So we should not say that, oh, give me your money, I will generate 72% every year. That's not realistic. So the people should have normal expectation come into the fund.
Excellent. Now, we're here on the Smart Money Program, and you give us a very good company, Potash, and you say it's a good company to invest in developing right now. You said we should research the Canadian banks to see the status and what the futuristic growth can potentially be. Give me another quick money tip, a smart money tip to say, Frank, this company, the valuation looks good. If you invest, hold for the next 3 to 5 years, you can make some money. What's another company, Jeeva?
I will give you another tip called Genworth Financial. That's the insurance company. They are in a distress market right now, but US real estate market is going to come back, already showing sign of real estate already bottomed. So whoever buys it now, if they hold it for 3 to 5 years, I guarantee that they can double their money.
Whoa.
It's trading around like $5.50 right now. The company book value is around $30, but their Australia business lost some money in the first quarter, but they are going to generate a profit this year. So whoever buys it today, hold it for 5 years. If it is not doubled, call me.
I like that. You says you're going to guarantee on January financials.
Yeah, definitely, because I did a lot of research on this company. All the downside is already there. So buy it slowly, buy it now. You can make great money. Even last year, it was around $5. It touched $9.80. Now again came back. So
Right.
I bought it around 5, sold it around $9.50. Now I'm buying it again, so I can make money in the stock.
Excellent.
So normally I don't talk about my picks to my investors, but it's special for the interview. I gave away to my holdings.
Oh, thank you, thank you. And what's the status of the U.S. banks in this whole financial crisis and the U.S. companies?
Now U.S. companies and U.S. banks are recovering. U.S. corporation balance sheets are improved a lot. They learned how to do a lot of things with less manpower. So corporates have a lot of money in their balance sheets. Even banks, delinquencies are keep on coming down. Their capital levels, it's going up. So U.S. banks are in a good condition right now. So when Federal Reserve increased the interest rate in 2014, their net margin income, it's going to improve a lot.
So should we be looking at holding a position in maybe in Bank of America?
You got one of my other pick also. I'm holding Bank of America too. So I bought it around like $5.20. I'm still holding it. So it's went around 10. Now it's around $7.50. So it go up in the future years.
Excellent. If I continue, I'm gonna get your whole portfolio today, but I'm not gonna do that to you.
I think you already got 3 picks. I think it's enough, I guess.
I think so. I think that's enough. Okay. Again, folks, we're here with Jeeva. He's a manager of the GJ Investment Funds. He's also the author of this wonderful book here, and you got to buy this book. You got to read it. It's if you want to create your own portfolio and get some good tips on how to start researching companies and to change your financial situation, creating a portfolio like Warren Buffett, author Jeeva. Jeeva, thank you very much for being on the Smart Money program. You can come on here anytime. I love your tips.
Okay. Yeah, thanks, Frank. Thank you very much for this opportunity.
All right. Again, as we promised, folks, when you watch the Smart Money program, you're going to get a wealth full of information like you just got today. I want you to thank you very much for your time and see you next time. Thank you.